Hello, hello. So today I'm going to be giving you guys all a class on the Federal Reserve. So I'm going to be leaning on my background in economics and my education at Oregon State University to really break this down for you. A lot of people in the real estate industry don't understand the Federal Reserve. They don't understand their mission, kind of what role they play in the real estate industry. A lot of confusion on the rates, what the Fed does and doesn't do in terms of setting rates. And we're going to break all that down and more. We're also going to cover a couple slides on just talking about recessions. And you're going to be armed with some data and some facts to go handle those objections with your clients and hopefully win more deals. So again, this video is really for real estate agents, brokers, and even lenders. And so this is a class that I've given before, but I wanted to just record it and get it out there and basically let people kind of get clear on who the Federal Reserve is and what they're doing. A lot of noise in the news right now and a lot of confusion. So here we go. So what you're going to learn who the Federal Reserve is, what rates they control, what rates they do not control, and basically what you can do about it now. And that's going to be the economic analysis, those bars and charts, and arming yourselves to win more deals. So who the Federal Reserve is, the technical definition, it's a federal agency. It is not actually a part of the federal government. It's an independent entity. It's actually private. It's about as federal as Federal Express. It is a board of governors in Washington, D.C., and 12 regional banks that sort of implement the policies. To understand the Fed, we also need to understand the federal government. And so the difference between the Fed and federal government is really, besides the terms that we use, it's their mission. And so the Federal Reserve's policy, the Fed policy, is price stability, full employment, and stable economic growth. When you hear Jerome Powell talk about the dual mandate, he's really talking about price stability, aka inflation, and full employment, aka the unemployment rate. When we're talking about the federal government, we're talking about fiscal policy, not monetary policy. Monetary policy is the Federal Reserve. Fiscal policy is the federal government. And so we're talking about the dollars, where they're spent. Infrastructure, fiscal spending, this is all like the stimulus checks of COVID and things like that. So when you think about the Federal Reserve, think interest rates, think value of the dollar. When you think about the federal government, think about stimulus checks and government spending. So what rates does the Federal Reserve control and what rates they do not? First and foremost, I just want to say the Federal Reserve does not set mortgage rates. They do not set mortgage rates. And I'll say it again, they do not set mortgage rates. The Federal Reserve sets or really influences the markets through two things. In the short run, in the short term, they control the U.S. economy through the federal funds rate. In the long term, they control the economy through mortgage-backed securities, among other bonds. The Federal Reserve's federal funds rate, that is HELOCs, credit cards, short-term debts. Mortgage-backed securities impact long-term debts like 20, 30-year mortgages, okay? So we'll dive deep into the first one, federal funds rate. So this is the rate at which banks lend each other money. So the Federal Reserve is really the bank of banks. The federal funds rate is set 8 times a year based on economic conditions. And this year it'll be set 8 times, but in previous years, if all goes well, they don't really need to mess with it. They won't. But again, it's for short-term debts like home equity lines of credit, credit cards, auto loans. This is the rate that the Federal Reserve uses to control the economy in the short run. So if they were to make it really expensive to buy something on credit, then people generally are like disincentivized to buy things on credit. And so that's why the Federal Reserve raised the federal funds rate to try to cool off the economy in the short run. Now, in the long run, one thing that the Federal Reserve does is they buy bonds, specifically mortgage-backed securities, which drives interest rates on mortgages. So when you think about mortgage rates, think mortgage-backed securities. And a lot of lenders don't even understand this stuff or understand how it works. But mortgage-backed securities are the only thing that drives mortgage rates. As mortgage-backed security prices rise, interest rates on mortgages fall. And as mortgage-backed security prices fall, interest rates on mortgages rise. There's an inverse relationship there. But what the Federal Reserve has done in the past is either buy or sell these bonds, these mortgage-backed securities. And by doing so, they influence the rate at which lenders lend money. And so particularly with COVID, they lowered the federal funds rate because they saw this recession coming. They saw the slowing down of the economy due to the virus. And so they lowered the federal funds rate. They bought up a ton of bonds and specifically mortgage-backed securities. And then now what they're doing is they're saying, okay, the economy is too hot. The economy is, inflation's on the rise, so we need to cool things down. So what they're going to do now, and which they're already in the process of doing as of this recording, is raising the federal funds rate to cool things off in the short run. And then they're selling all of the mortgage-backed securities that they bought previously. So when you hear about the Federal Reserve talking about selling off their balance sheet, or they're talking about their balance sheet in general, that's what they're talking about. They're talking about taking the bonds that they purchased and created all that fake demand for, and they're giving it back now to people who don't want it. And so by doing that, they're influencing mortgage rates. So it just so happens that the federal funds rate is rising and mortgage rates are rising, but the Federal Reserve, I can't say it enough, does not set mortgage rates. So basically, what can you do about it now? Now we're going to have the recessions talk, okay? We're going to go into some graphs, and these are very simple, but they say a picture's worth 1,000 words, and so that's why we're going to look at pictures. These graphs will really cover some big topics, some big objections that your clients will have, and as a real estate agent or a lender, you need to be able to overcome those, okay, and kind of disarm the clients because they're hearing a lot of nonsense in the news. So first up, we'll see in this graph, this is 30-year fixed rate mortgage average in the United States going back prior to 1975. So you can see the y-axis is the interest rates and the x-axis is the year in the United States. So you can see from 1975 to 2020, interest rates spiked just after 1980, and then they've just kind of kept going down, and currently right now are higher than they were in 2020. The gray bars in this graph are recessions. And so the distance, the thickness of the gray bar shows you how long that recession was. But basically what this graph is demonstrating is that after every single recession, rates have fallen. So from 1990, they went down, 2001, they went down, 2010, obviously housing crash, and then 2020, it went down. In 1980, we didn't see rates go down, and that was because there were two things going on. We had high inflation and we had high unemployment. And so in the economic world, that's called stagflation. Today, we have high inflation, but we do not have high unemployment. And so this is why some people are saying this is exactly like 1980. It's all happening again. And it's just not true. If unemployment were ridiculously high, if everybody was looking for a job right now and it just couldn't find one, and inflation was super high, we would be in a 1980 scenario. But we're not. And so this recession that we're in is different, and we need to take things into consideration in that way. However, going back full circle now, when your clients say, I think there's a crash coming, you'd basically say, yeah, good. I think there's a crash coming too. And when the crash comes, you can refinance in the future. Check out this graph. Look how rates have fallen after every single recession. So next, we're going to talk about rent versus own and appreciation rates. So this graph is showing you the house price index for the United States. And again, gray bars are recessions. And you can see that home prices have done well and have actually risen through and after every single recession. And the only recession that housing prices fell was in the 2008-2009 financial crisis. And so people are just assuming, especially the younger generations, they're assuming that every recession means home prices will fall. And they're saying that because they just saw that in that first recession of their lifetime. People have been around the block, kind of understand that every recession is different and they're caused by different things. So again, 2008 caused by housing. That's why housing had a dip, but in every other recession, you can see home prices have done really well. And so you need to be able to, again, full circle here, go back to your clients and say, look at this graph. Even if there is a recession, your home will continue to add value. You'll continue to see appreciation, especially in our market, like in the Northwest. And renting is really 100% interest rate. There's no principal there. It's just all interest. And so owning is really just a forced savings account. It's a good investment. All of the things you guys already know. But with the help of a little graph like this, it can go a long way. Okay, and then what you can do about it now, again, last slide. This one is just kind of a funny one. It has nothing to do with nothing, but I'm showing you to understand that there's a difference between the national news and the local market and how that doesn't correlate. The sound bites that your clients are hearing in the news versus what you actually know to be true, how that doesn't correlate. And so this graph is showing you active listing count in the United States. And so if you go from the left-hand side all the way to the right, you'll see we start in January 2017. You'll see it goes up to July of 2017, then it falls to January 2018, then it rises again in July of 2018, and up and down, peaks and valleys it goes all the way to today. So what your client is hearing in the news is inventory levels are at the highest level they've ever been since July of 2019, or inventories are at the lowest level that they've ever been since July of 2020. And taking things out of context like that, like these little soundbite things, like they're not wrong. Inventory is at that current level, but they're not telling you the whole thing. It's like my mom used to say, it's lies by omission. What the news is not doing is they're just not showing you the whole picture. They're omitting certain things. And for them, it makes sense. If it bleeds, it leads. They need people to click on their articles and stuff. But what you guys need to be able to do is take this graph, show your clients where inventories are actually at, right? And we are still very much at a low level in terms of inventory. We are still very much so in a seller's market. And so buyers are thinking they're getting away with murder now because they've heard inventory levels are at the highest level they've ever been, yada, yada, yada. So while inventory levels are at the highest they've been since January 2022, they're at the lowest levels they've been just historically, right? And so this graph is a prime example of what the news is talking about versus what we all know to be true. And I always tell people, don't confuse the weather for the climate. You know, if you walked outside your house today and it was hailing, you wouldn't just assume the world froze over. If you walked out your house the next day and it was 112 degrees outside, you wouldn't think that the planet was melting. And so this is what the news is doing. The news is the different weather patterns day to day. What you and I are as industry professionals is sort of the climate, the overall picture of where things are at. So yeah, that's pretty much all I got for this little class. Again, talked about the Federal Reserve, who they are, who they're not, what rates they set, what rates they do not, and then talked about recessions and what you guys can do to have those conversations with your clients and just better arm yourselves for those objections. And again, I would say, you know, with this slide, dial in your scripts and have these objections handled before they're brought up. Because anytime a client says something about a recession or this and that, and then you try to sell them on why you know more, you know, it's a day late and a dollar short. What you need to do is call out the elephant in the room. Hey, I'm sure you've heard this, or I'm sure you've heard that. Or you can say, hey, tell me what you've heard about the current real estate market. And then they'll tell you everything that you've heard. And then here you go. Start whipping out the slides during your listing appointments or what have you, and break it down for them. And then this builds trust. This builds rapport. And really, it's not sales anymore. It's just facts. You're pointing to the graphs and the sheets and saying, look, this is what the data tells us. Then it's not a me versus you or us versus them problem. The client will just have to basically swallow that bitter pill because the numbers don't lie. So again, I hope this helped you guys win more deals. If it did or did not, let me know. If you'd like to go in depth on anything else in particular, I'd love to be a resource to you. Comment below if you thought this video was cool and you'd like to see more economic videos like this. I'd be happy to do it. But other than that, I'm signing off and I'll see you guys in the next one.